Welcome, everyone. Thank you for joining us today. I suppose it's morning for some and afternoon for others. We have folks joining us from all over the country this morning, and we're really excited to have you all with us. Thank you also for sending in questions. We will look to get those answered at the end of today's session. So my name is Janine Drake. I am the Senior Director of Marketing here at Founders First. Many of you know us, but for those of you who do not, Founders First CDC is the largest national platform for growing businesses led by diverse founders. We offer strategic accelerator programs, coaching, grants, and valuable content in funding, resources, and education, much like today's webinar, to help you grow your businesses to 10 million and beyond. We were founded 8 years ago as a 501(c)(3) and we really appreciate the ongoing support of our members and partners. So, getting into a couple housekeeping items for today's webinar. This webinar is being recorded, so don't worry if you get kicked off. We will definitely be sending the recording out to all of you that have registered. There will be a Q&A session at the end of the program, so please feel free to submit those questions through the Q&A feature at the bottom of your screen. And finally, if you lose connection, just use that same link to hop back on. This session will be 1 hour, so we are encouraged to be able to answer all of the questions that you've submitted, in addition to all of the questions that you will submit as our speakers go through their presentations. So today's presentation is all about navigating the funding landscape. It's designed to illuminate the different types of funding available and what you need to know about each. We are joined by Ela Gomez, Banc of California. We are joined by Amy Nelson, Rethink Capital Partners, and we are joined by Oscar Franco, Founders First Capital Partners. Ela is up first. A little bit about Ela. Drawing on over 20 years of experience in the banking industry, Ela provides financial management, new business development, strategic marketing, new product development, and M&A escrow services to select industries. She's held diverse individual contributor roles in retail, commercial, and specialty banking at a number of financial institutions. Ela received her Bachelor of Science degree in Applied Economics from De La Salle University and has completed the certificate in private capital markets from the University of Pepperdine Graziotto Business School. She recently finished a certificate in women's entrepreneurship at East Cornell. Welcome, Ela. I will go ahead and share your slides now. We are thankful to have you. Make it in here.
You'll share the slide, right, Janine?
Coming right up, yes. Okay, here we go.
Okay. Hi, good morning, everyone. Again, I'm Ela Gomez. I'm based here in Costa Mesa, Southern California. Been in banking for 20 years, as mentioned. So I just want to start off first, Banc of California. We just finished and completed our merger with Pacific Western Bank. So it's like a David and Goliath. So a little background, Banc of California is less than 10 billion in asset. We acquired Pacific Western Bank, which is triple our size. So our asset size as of today quadrupled to 36 billion in asset, meaning would be we are going to be well capitalized. We'd be lending more, and we have a high liquid in the market. After the merger, we've become the third largest bank headquartered in California. Our corporate office is now going to be in Los Angeles. Management team is going to be under Banc of California, headed by our CEO, Jared Wolf. And from 29, we're going to grow into 70 branches and 2,300 employees. So that's a little background about Bank of California and our strength. You can go on the next slide. I think one of the questions or topics are on the agenda for this meeting are what are the challenges that the banks are encountering right now? So we can go on the next. Well, the bank right now is going through a lot of competition. With all this transformation going on, in order for a bank to be competitive, us as a traditional bank and other smaller credit unions have to provide more access to technology, products, and processes, meaning new customers have bigger demands for requiring us as a bank to become digitized, to be more customer-centric, more products and platforms available for a bank. So those are the challenges we're encountering as a community bank right now. You can go on the next. Another challenge for a community bank or other banks is the cultural shift, meaning everything is very automated right now. As you can see, technology is number one. Everybody is accessing through their mobile apps or computer. AI is a big feature that's coming up in the banking world, digital transformation, and cloud. Now, as a traditional bank, a lot has been manually processed in our systems. So now all the banks are investing money in technology. For example, we accept Zelle payments on the consumer side, and we are upgrading everything on the business side. Accepting a digital transformation means we have to leverage a lot of data and technology guided by human. At the same time, with this evolvement for a cultural shift in digital, we need to make sure we become efficient, not only in the digital side, but also making sure that customer is the focus. There is a sense of urgency for transformation, and it also takes and requires a lot of money and time for the bank. So next, please. Now, with all the changes happening in the bank, as you can see, regulatory compliance has become one of the most significant banking challenges from the result of the 2008 and the recent happenings in SVB. So the bank has a lot of update with keeping up with new policies, standards, controls, new regulatory requirements. It is a very vital part of our business to be in compliance so we can keep up with the constant changes in banking. Next, please. With the change in business models, we also have to create new service offerings for our clientele, rationalize business lines, seek sustainable improvements in operational efficiency, and then failure to adapt in changes is not an option. So therefore, a lot of the banks right now are getting more creative in providing more products. As you can see in the picture, not only in finance, credit card, wallet, everything. We need the market share for us to succeed and for the clients to become sticky. So we need to keep on upgrading our business model and platform in order to catch up with the demand, especially with Gen Z or millennials. They want everything fast. They want everything automated. So a lot of the banks are changing their business models in order to adapt to this type of generation of clientele. Next, please. I know a lot of you are small business owners to middle market. One of the, I think, topics that needs to be discussed, what are the basics of lending? How does one get a bank line or a bank loan? So the bank look at 5 C's of lending: character, capacity, capital, collateral, and condition. Now, what is character? Character is all about your credit history. So the bank, when we look at the loan, we look at your borrower's reputation, your track record. Are you paying your credit card? Are you paying your car payments? Are you paying it on time? Are there lapses in payment? This is all bounces back to your character. How are you able to pay back if you apply for a loan? We look at your FICO score. Minimum for a bank is 680. We have to also find out, did you have a foreclosure, a bankruptcy, Did you have any derogatory? So it's very important to be honest with your banker when you're borrowing money, because we need to know your story on what happened there. Why did your FICO drop? So it's also about lifestyle. So when you're looking at the loan, we look at the character of the borrower. Now, what is capacity? Capacity is whether you can afford the payments. A lot of clients, they want to borrow 1,500,000. We need to understand, how can this help your business? First of all, we need to measure your ability to repay the loan. It's not just borrowing and throwing a number from 1 to 1 million. We need to understand what's your debt to income ratio, meaning we need to understand how much debt you have over your assets. The minimum required for a debt service is 1.28, meaning for every dollar you borrow, you have to have liquidity of 1.28, or you're making enough income for that. The third C for lending is capital. Capital is important. Where did I put that? Capital is important because we also look at how much can you pay? How much is enough for your business? One thing that the lenders are looking for is not unsecured lines, collateral. Collateral would be your personal asset as a borrower. How can you support the loan if you stop paying? In short, lenders need a backup. If you are unable to pay your line of credit for the business, we need to make sure we have a backup, which is maybe your residential mortgage, your inventory, your equipment. Those are important things that the bank looks in terms of underwriting. Now, conditions. Conditions is the last 5 C's for lending. A lot of us bankers and underwriter, we need to know what's the purpose of the loan. Is it going to be used for equipment, inventory? How is it going to be helping the business? Just an example. We have clients who are borrowing 1 million against their property. At the same time, we look at their personal financial statement, they're buying a Maserati. So it's not really investing for the business, but they're investing more on their personal lifestyle. So that loan was a decline. So the banker and underwriters look at every condition, especially all these 5 C's in lending. Next. So when we look at the loan, what are the factors or what we look for? First of all, we look at the industry. What type of industry? There are certain industries that are restricted in a traditional bank. For example, gambling, firearms, illegal substances. Those are not the type of industry that we would lend money to. We would prefer a typical manufacturing company, anything that's business to business or even business to consumer, but just make sure it's not in the restricted industry. Now, a typical bank would look at the time in business. We always look at historical financials, which is mostly 2 to 3 years of business. We look at your global cash flow, not only if you're making revenue for your business, we also do look at your personal financial. For example, if you have a mortgage, it's a long-time commitment. We want to make sure that you'll be able to afford to pay your primary residence and also your line of credit. So we look at a global holistic approach, especially when we're doing underwriting. Again, third, credit score and history. Bank looks at 680 minimum, and we look at the story behind the credit score. How can you pay back? How much you're owing? How are you managing your credit and everything else? Cash flow is very important. This is referring back to being able to pay your loan. Loan amount. Loan amount is what business owners request in terms of a line or a loan. It all depends also on your debt service. So everything is interrelated. Now, a lot of you probably are startups or just started 1 to 2 years. This is very important. We need to have a collateral as a backup for the bank. We might look into either inventory, mortgage, you own a building, those are collateral that we look at. Now, why is business plan important? Lenders like us need to understand what's the company's viability? Are you profitable? Is this just a fad? Is it something that you did a market study or you just woke up one day, I want to start a business and borrow? We need to know the story behind why are you investing in this type of business or why are you opening this type of business? Do you already have a background? Let's say a restaurant, where have you been in that industry? So we look at the personal resume as well on how you can support the business plan. Again, going back to debt, we looked at how much you're borrowing and what's the money going to be used for. So these are just all the basic that the bank looks in terms of a line or loan approval. And I think that's it. So we can share the slides later on. Thank you.
Well, that was fantastic, Ela. Thank you so much for sharing that. Not only the insights of, how Bank of California is, approaching competition and really being customer focused, but those 5 C's of capital. I mean, very informative. Really appreciate that information here. So up next, we have Amy Nelson. I'll give you some background on Amy. Amy Nelson is the Chief Strategy Officer for Rethink Capital Partners. She oversees the firm's development of new strategies and supports the growth and operations across the platform. Prior to Rethink, she spent 8 years at Venture for America, an organization that selects, trains, supports the next generation of entrepreneurs, including 4 years serving as their CEO. Amy has also held business development positions at B Lab, Relief International, and the Cambodia Children's Fund. She sits on multiple boards and is a graduate of the Claremont McKenna College and NYU's Stern School of Business. Welcome, Amy. Thank you so much for being here. Take it away.
Thank you, Janine. Good afternoon or good morning, everyone, depending on where you are, or maybe it's night if we're, somewhere else in the world. I am going to talk a little bit about equity financing today, and I don't have slides. I apologize. But we're just going to talk sort of broad strokes. So I am a partner in a venture capital firm, and I'm going to mostly talk about how venture capital works. But venture capital is really just a subset of private equity, which is essentially selling a piece of your business for an infusion of cash. Generally speaking, as a business owner, equity funding is going to be the most expensive way to fuel your growth. And venture capital in particular tends to be for earlier companies. Private equity tends to be for later companies. And private equity could be a growth infusion, or it could be buying out your business, even if you continue to run it. There's a lot of different ways that those deals can be structured. And generally speaking, venture capital, which I'll speak more about, is relevant to less than 1% of companies. So it's a small universe. And venture capital typically applies to very high growth companies. Private equity tends to be more for companies that are profitable, stable, and also growing. Before I get into the specifics about how venture capitalists or private equity companies might structure a transaction or an investment, I think it's always important for companies to understand how VCs think and how they make money, because sometimes there's a perception that we're just sitting on piles of cash, and we just like to say no to be mean, and that is 1,000% not true. We love supporting companies and their growth. But at the end of the day, most venture capitalists are not investing their own money. They are investing on behalf of others. So I personally have to go around the country and meet with high net worth individuals, family offices, maybe some larger institutions, foundations, pension funds, and convince them to invest in us. And they see that as a very, very risky bet. And so in order to convince them to invest with us, they need to see a return that's far above what they would get if they made a different type of investment, right? In the stock market or something else. And so that's how we get our money. And then how we make money is through what's called a 2 and 20 model. So if I have a $100 million fund, which sounds like a ton of money, and is a decent size fund, a pretty typical size fund in venture capital, I pay my team with 2% of that 100 million every year. So we take 2% as fees. So I have $2 million every year to pay everyone who works for me, to pay my rent, to pay my travel, keep the lights on. So it's not a huge amount of money, right? And so that's why these teams tend to be very small. And then 20%, which means once I have returned 100% of capital to my investors, generally speaking, I get 20% of any additional profits above that. So we have a very high hurdle rate that we need to meet in order for us to see the benefit of our investments. And so we then think about a distribution of bets, right? So a good outcome in a venture capital scenario is if you make 5 or even 10 times your money. 2 or 3 times your money is considered good. But 5 is really what you're underwriting for, and oftentimes it's 10, depending on the profile of the fund. But we also tend to assume that about 30% of the companies that we invest in are going to go to zero, right? And so you've got that sort of bell curve distribution where you're looking for some really outsized wins in order to ultimately make money for yourself, because you've got to return capital to your investors before you ever see a dime. So that's how we think, how we make money. And we're in this business because we really actually love to support startups. The vast majority of venture capitalists do it for that reason, and because they think they're smarter than other people and they can make money. Now, if you're going out and trying to understand the landscape of venture capital, it is a small and fragmented universe. We read a lot about VC in the papers because there is some outsized influence, but within financial services, venture capital is a teeny sliver. And most companies ultimately will meet with multiple VCs, and every VC is a little bit different. So they're, depending on how you count, there's between 2,500 and 10,000 venture capital firms. Some of those might be owned by a company, some of them might be independent. There's a lot of different subtypes. And some of them are what are called generalists. They invest in just about anything. Some of them are thematic. They, maybe only invest in software businesses. Some of them are industry specific, so specialists. And actually our funds at Rethink are considered specialist funds. Our fund Rethink Education, for example, only invests in education technology companies. And then another way that companies tend to differentiate themselves is by stage. So you may have someone who's a seed stage investor. That's one of the earliest stages. But then some companies only invest at what is called a Series B or Series A. And so before you go out to raise venture capital, you need to do some landscaping and understand, does this firm invest in my sector? Do they invest in companies that are similar to mine, that are in my industry, or have my business model? And then do they invest in companies at my stage? Right? Because there's a whole swath of firms that won't even look at companies until they're further down the line. So you need to really understand who you're talking to. And then you have to expect to work with multiple VCs. And so a typical company sort of growth profile is you start out and you bootstrap from capital you may already have. You may get angel investment or pre-seed investment from friends and family, people that groups that you're a part of, if you're fortunate enough to have those networks or to have some capital of your own. And then venture capital tends to come in. An initial investment tends to be when a company has somewhere between 300,000 and $1.5 million in revenue. Not hard and fast. There are plenty of companies that get investment who have $0 in revenue and people are just betting on an idea. But typically for a seed round, that's what you're going to see. And it's very rare that when a company first gets venture capital, they're profitable. It's not impossible. It definitely happens. But generally, you're looking at companies who are favoring growth over profitability in the early stages of their journey. And so for most VCs, it's all about growth acceleration. They're looking at least 50% year over year growth. Typically, some want to see 20% month over month growth. So it really is about how is this company get from the stage they're at today to where they're going, and how quickly can they do it? And the reason that timing matters is that our funds have a life cycle. So after 10 years, we are expected to have returned all of our capital and then some to our investors. So the only way to do that is if we sell our shares in your company to somewhere else, or if you sell your company. And typically that is the easiest way to do it. And so given that, I'm looking for what's called an exit or liquidity event within 10 years, and I want to make back at least 5 times my money on you, you need to be aware of the pressure and the constraints that is going to bring, and you have to kind of sign up for that deal, right? And so, when you're entering in a financing, you can expect to do lots of pitching, meet dozens of VCs, and they invest in less than 1% of the companies that pitch them. It's not personal. They're just looking for things that fit their mandate. They also typically won't invest in something that's competitive with another company in their portfolio. So you got to have thick skin and get used to hearing no. And then once you do have a company or a firm that's interested in you, you can expect that they will have a really deep diligence process, typically about 6 weeks per firm, where they're going to meet with you multiple times. They're going to dig into your books and records. They're going to talk to your customers. They're going to talk to any other investors that you have. They might call up your former employer without asking you and ask questions about you, because they are making a really serious bet on you, and they want to have a really deep relationship of trust. And in the future, hopefully they're going to help you out in ways that are not just money, because they're owners of your business. And so they're aligned with you in ensuring that you are successful. And overall, that initial process takes months. Sometimes it takes a year to raise a round of venture capital. And then the venture capitalist is typically going to set the price, which would typically be a multiple of revenue. So it could be anywhere from 6 to 20 times your revenue, depending on a lot of different factors. That's a normal range. And so they're going to buy equity at that price. And then your future valuations are going to be based on your continued growth rate. And at some point, profitability will come into play. And it depends a lot on the rate of growth, the industry you're in, and a number of different factors, how later financings are going to think about that value. But over time, you typically are expected to become profitable. And that's going to be important for all of us for that liquidity event. Although plenty of companies sell before reaching that milestone, I will say. But it's important to just think about, once you're on the VC treadmill, it's really hard to get off. And so I just always want to set expectations that there are a lot of other ways to finance a business, and this one isn't always the most comfortable. And so you need to know what you're signing up for. But if you are in an industry that has a lot of opportunity and you have a really differentiated approach to how you're solving a problem, then venture capital absolutely can be the right type of financing for you. And I would encourage you to find the right type of firm that really understands you and your business and is going to be aligned with your values and your mission, and who's going to support you along the way and provide more than just money. And with that, I'm going to pause, and I'm happy to answer some questions when we get to that part of the session.
Wow. Thank you, Amy. I definitely have some questions that I jotted down. I will save those for our session at the end. I do want to remind all of our attendees today to go ahead and put your questions in the Q&A. We do want to make sure you're getting the most out of this webinar, and getting those questions answered will help us with that. So on to our final panelist presenter, Mr. Oscar Franco. Oscar is a distinguished business leader with a focus on selecting, accelerating, and promoting entrepreneurs in the US, Mexico, and Latin America. With expertise in consulting, strategy, fundraising, sales, and event planning, Oscar has spearheaded Endeavor Mexico's national selection efforts, collaborating with top entrepreneurs in that region. He played a pivotal role in developing new services for entrepreneurs, implementing diverse fundraising strategies, and organizing successful investment events. Currently, as the investment manager at Founders First Capital Partners, Oscar connects with small to mid-sized businesses led by diverse founders with non-dilutive growth capital options. His work aligns with Founders First mission to bridge racial and socioeconomic gaps by facilitating the growth and scale of these companies. Oscar, I will share your slides and welcome.
Perfect. Thank you, Janine. Appreciate that. And once again, appreciate our panelists, Ela and Amy, for joining us today. A quick recap, Oscar Franco, investment manager at Founders First. Been working with entrepreneurs essentially all my life for the past 10 plus years from multiple aspects, right? From accelerators, incubators, now on the lending side, connecting entrepreneurs with VCs, not only across Latin America, Europe, the US. So definitely very, very well tied into the entrepreneurial world. So with that, I'm representing Founders First Capital Partners today, and just want to give you a quick rundown of who we are, the type of companies that we work with, and some examples of some of the products that we can offer for some entrepreneurs. So next slide, please. Yeah, so this is just a quick summary, as Janine mentioned. Founders First Capital Partners, our mission is essentially to level the playing field for underrepresented founders, meaning companies led by women, minorities, veterans, LGBTQIA+, and those who are operating in low to moderate income areas, and those committed to diverse hiring practices. And how do we do it? We do it through essentially three main buckets. One is through our CDC side, our nonprofit. We run accelerator programs. We have three different ones depending on the revenue stage of the business. So we have an entry-level program called Challenge for companies between 250 up to between 50K up to 250. Then Bootcamp for companies between 250 up to $1 million, and then FastPath for companies from $1 million above. All of those programs essentially tailored for different growth stages for entrepreneurs. So that's one of the things that we do. Secondly, we provide grants. Those are free money. There's national grants, regional grants. If you're interested, go to foundersfirstcdc.org, go under grants, and you're going to see more information on when are the deadlines to apply. I always encourage entrepreneurs to apply. In addition to some free money, you get a full scholarship to join one of our accelerator programs. So I'll definitely, if you happen to know any entrepreneurs or yourselves interested, please go ahead and apply for one of our grants. And lastly, and not least important, we also provide funds for the entrepreneurs. We do that through three different products that we have. We have our term loans, revenue-based financing, which I'll discuss a little bit more later on, and our hybrid product, which is sort of a combination between our term loans and RBF. And just lastly, primarily, the companies that we work with, again, led by a diversity founder, primarily B2B businesses with recurring revenue models, revenue sizes between 500K up to $1 million. Next slide, please. So revenue-based financing, and I always like to pause and discuss a little bit more about this product. It's not that very common, or maybe it's not as famous as other type of loans out there. If you're familiar with a term loan, revenue-based financing is it's very similar, but instead of having a fixed payment on a monthly basis, there's a variable payment on a monthly basis, depending on the company's net cash receipts. So for those companies that have some seasonality to it, on a stronger month, you're going to pay a little bit more of your loan. On a slower month, you're going to pay a little bit less. This is a great opportunity for you to be flexible in that way and find a lender that is willing to be in the risk with you as well. In addition to that, here are just some of additional benefits of working with this model RBF. There's very limited financial covenants. As I said before, payments will be solely dependent on the company's performance. There is no loss of control, as Amy mentioned, in comparison to equity. We don't require any board seats. We don't have any ability to replace management. I mean, essentially, we're not an equity provider for the companies. No pledge of the specific assets. Again, going back to Ela's presentation on collateral, we don't pledge assets or any specific assets of the borrower. Very aligned interests. Again, depending on the company's performance, our IRR is going to be very aligned, right? If the company is performing great, that means that our loan is getting paid a little bit quicker. Essentially, everyone is happy with the relationship. Advice, and I think this is one of the things that really sets Founders First apart. We do offer wraparound services for the companies that we work with. Those are essentially mentoring, coaching calls with some of the advisors that we have here at Founders First. And the whole idea, the whole purpose is to make sure that we can help you not only craft that growth plan, but make sure you're keep not only on track, but develop those OKRs, KPIs, whatever methodology you're using for track performance, and get access to that, right? So that's not necessarily something very common that lenders offer. And just lastly, again, going back to Amy's presentation, if you're a founder that has a potential exit strategy in mind, right? So if there's more shares owned by the founding team, that means that once you get to that exit, you're going to be able to have much higher returns in comparison to only funding your company through equity investing. Next slide, please. Now, getting into more specifics, and I know that was one of the questions that I got to ask in advance of this presentation. So whoever sent that question, I appreciate that. So essentially, what are some of the characteristics that we look in a business in order to sort of make it a fit for our financial products? One, business revenue, preferably 1 million plus, meets one of the following requirements: a women-owned led business, person of color, veteran, LGBTQIA plus, companies located in a low to moderate income area and committed to diversity hiring practices. Profitable, again, that puts you in a much better position. Break even or a path to profitability. I know that was one of the questions that I also got in advance. You don't have to be profitable to apply to one of our loans. However, we will definitely take a look at your financials and try to understand what is that path to profitability. How does that look like? Is it 6 months from now, 12 months from now, 18 months? We just want to understand where essentially the burn is coming from and what is the plan to essentially improve the profitability behind the business. Growing revenues, positive trends, kind of similar to Amy. We want to make sure that we're working with a company that is growing, that is showing positive trends, not only year over year, but also quarterly. Recurring revenue contracts and predictable revenue models are a best fit. And I think this is one of the most important things, specifically for RBF. A great example, and I'm going to delve into it later in one of our next slides, a SaaS company, a SaaS business model, right? That's essentially a perfect fit for what we do here at Founders First. A service-based business with multiple clients, master service agreements, some sort of retainer through them. That's also a great fit for our models. And time in business, at least 2 years of operations. Next slide. Very similar to Ela and Amy's presentations. As a lender, we also have the industries that we believe our products are a better fit, and we also have some industries that they're just excluded out of our funding guidelines, right? So just doing a quick recap, I don't want to be repetitive, but businesses that works best, asset-light businesses, service-based businesses, companies with long-term contracts in place, recurring revenue, SaaS, tech-enabled, tech-adjacent companies, are historically ones that have proof or evidence of being more high growth. Those are essentially a great fit for our products. And consulting companies who are more quote-unquote traditional, marketing agencies, advertising agencies, consulting firms, they are also a good fit for that recurring or predictable revenue model. Some of the industries that are excluded from our products, the cannabis, weapons, gambling, liquor, nonprofits. I know we got a question in advance about nonprofits. We don't. However, if you're interested, we do have some partners that I personally know that work with nonprofits. Happy to make some referrals for you guys in that way. Next slide, please. Now, just a quick funding example, right? So one of the additional questions that I always get asked is, well, what is your average loan, more or less, and how much money can you lend to a company, right? So average loan, I think that's going to be changing just because of some recent performance, but I would say 350, 400K, more or less, I would say is the average loan here at Founders First. We can go up to 1 million in the first exhibition, including follow-on rounds. We can do up to 2 million per company. On this revenue-based example, again, since the payment is variable, that is not a set interest rate. Monthly payments are 100% going to be variable depending on performance. If you happen to have a bank loan or an SBA loan we're more than happy to be sitting in a second or third position to them. So anything additional to that, any MCA loans or any high interest debt that you have, we will need to refinance that debt and take them out of your balance sheet. Now, in this example, I mean, the company's 1 million in revenue, the principal is 200K, term length on an average is going to be anywhere between the 3 to 4 years. The royalty payment, which is that the revenue piece component I was talking about, is going to be anywhere between 2 to 5%. Repayment, that is the total obligation repayment to us. It's going to be a 1.3 in this example. So the 260K in a period of 3 years, that is essentially your commitment under the loan. Now, moving on to the next example, if you go to the next slide, as you can see, it's pretty much the same. The only big difference is going to be on the payments. Instead of having that royalty component, you're going to have a fixed payment with a set interest. In this case, the payment will be $7,222 every month. And just lastly, on the hybrid product, what essentially it's going to be is it's going to be a fixed payment component with a floor rate on it, in addition to a small revenue component, depending on the revenue when a company hits a certain revenue threshold. So that is essentially an additional product that we're launching in the market. We are very excited about that one. So more than happy to discuss and share more information if you're interested in. Next slide. Just lastly, as a wrap around, we always are looking forward for companies that are at a growth stage. Just to give you an idea of the funding landscape and where do we land. I always like to position ourselves, and again, tying it up to Amy's presentation, companies that are post-seed funding before Series A, I would say that is essentially a good parameter of where do we stand in the funding landscape. But again, more than happy to answer any questions you have. And I'm looking forward to continuing the conversation. So thank you for inviting me, Jenny.
All right. Thank you, Oscar. That was fantastic. You really delved into the alternative funding options that are out there, and specifically through revenue-based financing and some of the other products offered by Founders First Capital Partners. Okay, our panelists, if you could all please come off mute. This is the favorite part of the webinar for me, and that is our Q&A. So we will proceed into this question time. We did have a number of questions that were submitted during the registration process. So we'll jump into those, and then we will check in on our chat to see if there's any additional questions via chat. Okay, so first question up, and please, Ela, Oscar, Amy, feel free to answer any of the questions, all of the questions, wherever you can lend some of your expertise. Okay, let's get started here. So, what funding is available for a home-based business with limited revenues that is now looking to move into a brick and mortar in order to enlarge their customer base?
Can I ask first, do they own their own residential? Because those are factors in how long they've been in business, home-based, moving to a brick and mortar. Do we have
Okay.
information on that?
Okay, so these are the questions that came in during registration. So we don't necessarily have that information, but assuming that's a yes, Ela, how would you recommend?
If the business has been ongoing for 2 to 3 years, that's what we look for in the bank. Otherwise, we are also SBA guaranteed lenders. We work with our SBA partners and see if they can get, depending if it's a nonprofit, maybe they can get a grant or can do a small business line of credit. We look at everything. If there is collateral and a personal guarantee, we would be able to help them move to a brick and mortar.
And I think Ela nailed it. I think depending on the business model and what industry they're in, they can potentially be other allies. To Ela's comment, if they're a nonprofit, I mean, there's grants out there that you can continually to apply. But yeah, I wish we had a little bit more information on the business model too, so we can provide a little bit more clarity on it.
Yeah, and apologies, I need to be off camera for a bit, but I think, you know, a lot of brick and mortar businesses don't end up raising venture capital because of their sort of intense capital needs, and VC tends to prefer things that are capital light. And we would probably ask, why do you need that physical location in order to grow your revenue? Are there cheaper ways to do it using, you know, digital tools?
Great, thank you all for that. Here's one. I'm looking to start a brand new venture with 2 to 5 employees, certified and ready to work. I'm looking to fund the company for the first 6 months and will need seed funding for the initial CapEx and near-term OpEx costs. Please share your thoughts.
I mean, I can jump real quick. First of all, try with your local bank. If it doesn't work, I think Amy's professionalism, trying to raise funds through friends and family, maybe through investors and seed capital, that would be another route for them. What do you think, Amy?
I agree. That's how I would go about it. I would try to understand, you know, what collateral that individual has that they can potentially lend against. I would look for a traditional bank loan, particularly because I do believe this is the kind of business that can become profitable very quickly, and so would be able to pay down that debt and then just work off of revenue on an ongoing basis. And then maybe, you know, debt finance when needed to invest in infrastructure.
And then just to add on, based on the industry, you're saying contractual, we also look who are their existing clients. Are they just concentrating on, let's say there's 10 clients, 80% of their contract would be just one person. That would also raise a few questions on the bank side, because we don't want it highly concentrated on just one clientele. It has to be spread out among the different. And sometimes contracts are just contracts, they can also be canceled. So we need to know what type of industry, who are they serving? Is it business to business, business to consumer? Are these contractors they're serving their services have been in business for more than 20, 30, or they have the expertise? So those are a lot of factors to be considered before venturing into getting a line of credit.
Okay, I will move on to our next question. Thank you for that. Where do we find lenders open to funding businesses that have consistently strong revenues, but have not kept a close eye on profitability as new business owners, and therefore have a couple of unprofitable years?
Well, go ahead, Oscar.
Yeah, I mean, happy to jump in. On our side, I mean, once we get a chance to review your company financials, as I've said before, being break even or a path to profitability is important. So we do work with companies that are not profitable, but I will definitely have some additional questions to it, right? I want to understand, to Amy's comment, if it's just primarily because you were prioritizing growth, maybe you recently raised some money and you were just putting it into marketing or setting your company to scale, and you're preparing yourself for some upcoming contracts or clients. You're going deep into your pipeline aggressively, so you need to hire some sales rep. So I want to understand what essentially is bringing your profitability down. And depending on the answers, depending on your growth plan and your vision, we can potentially start a conversation and figure it out. What are the next steps? But I'll always like to say this: financials as they are give us a great picture of where the company is, but also having those conversations and one-on-one interactions with the company and with the clients and the borrowers, trying to understand the story behind it is going to be important for us, right? So yeah, I think we are more than happy to work with a company that is not profitable, but we will definitely have some questions related to that.
And to piggyback on Oscar, we have a similar client. They've been in business for 30 years. They're in paving. We looked at their financials because they want to exit to a private equity. The reason they're not profitable because they're taking so much distribution to themselves. So a lot of business owners, I tell them, yes, you are having a revenue of 20, 30 millions, but you're not showing any net income. So we need to understand the story So with that instant, with my client, they have to step back and, okay, let's take less distribution on the shareholders, put more net income to the business. So it's you're right, Oscar. It's a different story. We need to know holistically, why are you not making revenue and how are you surviving? So there's a lot of factors. It's all about the story.
I'm going to ask this next question only because I think it might be a similar answer. What are the strategic steps that can be taken to secure funding when you're facing a lower credit score than usual, especially as we've been bootstrapping, we've had some credit cards, etc. So that lower credit score.
How low is low?
I mean, that's a very important factor for sure.
Okay, we don't have that information.
I mean, our minimum for us to lend is at least 680, but then we also need to know, why is your credit score? That means you have your debt, loan to debt is so high that your credit score is pulling you down. How are you even surviving cost of living? I mean, again, we look at the global cash flow, not only on the business, but your cost of living. How are you surviving yourself as a business owner in your business? So there's a lot of factors to consider regarding that. So
Great, thank you.
Yeah, and I would also just say
go ahead,
timing,
Amy.
right? Like you can do things to improve your credit score, right? And cure and you know, I know it always feels tight and it's very stressful and you need money right now, but if you can wait to put that, you know, financing together, wait, especially in this interest rate environment.
Great point. Great point. Thank you for that. We've got some questions that came in through the chat. I'm going to switch lanes. Can a business access funding if they are in the process of litigation? Great question.
is the litigation based on their company, a lien on the business, or is it more on the personal side? So
That is
those are
correct.
the things. Yeah, but us as a bank, we're very conservative. Just for example, a client wanted to do the line. We're doing a 200,000 line of credit. And then when we pull credit, there was a lien of $200, which is something we can make an exception. He forgot a bill 20 years ago, and that put a lien on his business. So if there's a story behind that, oh, I was in the hospital, I forgot, I changed addresses, 200. But we need to look at each story behind the litigation. I mean, we have clients who goes on bankruptcy and we still have them as client, especially if they're in special assets. It's a case-to-case basis.
Yeah, I would say case by case. But I think this is a great point. It should just a quick reminder, a quick advice for everyone in here. Be transparent about this type of stuff, right? Whether it's your credit score, litigation, anything on, once we get into our due diligence stage and we run all of our reports, everything is going to show it up, right? So transparency, and going back to Ila's comment on character, it's super important, right? So be transparent with whatever lender you're working with.
Totally agree.
Yeah, and I would actually say in venture capital, it's not a deal killer, but it's certainly a deal slower downer. And it makes it far less likely. It depends. Like we see all sorts of things around patents and intellectual property that come up between businesses. We see disgruntled former employees, you know, we see vendors, you know, that are maybe entering in litigation. Those things happen. And sometimes they're explicable, sometimes they're not, but I've also seen them litigation destroy business. So it's possible, but there would need to be like a really good story around it. And this is probably not relevant, but there are a small number of investment firms that actually specialize in litigation finance. If they think that you're going to be successful, if you are the one who is doing the suing and not the other way around, but it's a very small and niche and weird industry.
Okay, great. Thank you. Okay, next question. What funding is there available for a 7-year company with steady growth year over year to consolidate credit card debt? Specifically, this is a general contractor and facilities maintenance provider.
So they have revenue, but they have credit card debts. I mean,
Yep.
the easiest way is just to consolidate, just do a refi. I mean, it depends. If they own a building, they can do a refi, cash out, and consolidate debt, or if they have a credit card transfer. Just an example, I have this client, more on the personal side. She makes 180,000 annual income. She has a house in Newport, can hardly live. We had to refi, consolidate everything, pay it off, and then she can live comfortably. So there are different alternatives. But first of all, we need to know how much debt this person has. Where is it going? Is it going to the business? We can always do a loan term against it, so he can breathe better and have more money for the business. That's what I would recommend.
Yeah.
A loan term.
I would say it will definitely depend on the amount. I mean, how much is it? Is the credit tied into the business? Remind me again, Janine, what was the business model?
General contractor and facilities maintenance.
Okay. Yeah, I would say those two are important for sure.
Yeah, you're right. And sorry, Oscar. And same thing, if they're, because I have a lot of clients who are in facility maintenance, they make a lot of good money. So they have to check on the receivables. If a lot of them are 90 days past due, they better start calling these clients to pay them up, because a lot of them are probably extending more than 30, 60, 90. I have an instant client, they do landscaping for all the property management. They revenue size 10 million, but they're in so much debt. We looked at it, their ARs is more than 90 to 180. I said, start collecting money from your contracts. That's the only way you can pay off.
Okay, great. We've got a couple more questions and a couple more minutes. So, Oscar, you may have touched on this one a little bit before, but startup funding for a 501c3. Startup funding for a nonprofit. Thoughts?
If that person that asked that question has my email, if not, just a quick reminder, ofranco@f1stcp.com. Send me your information. I'll send you a couple of options. Yeah, I might need to take into my database and my network, but yeah, definitely happy to make some connections.
Thank you for sharing that, Oscar. We are going.
It depends, but friends and family is typically the place where people start for a 501c3.
Or if not, you can go to private foundations, corporations, they do a match. I mentioned to Janine earlier, our bank just donated 1 million to City of LA to support nonprofits lending. Yeah, big financial institution, they can fund your nonprofit depending on what type. There's government grants, there's government, there's money. I mean, the banks normally, let's say it's a nonprofit, we even do a match from 5,000, we match it another 5 to 10,000. So there's so many avenues. Yeah, donors, private foundations, banking, they can do that as well.
Yeah. I mean, I'm guessing they already have that in mind, but primarily to Ila's Amy comments, I mean, nonprofits, I mean, private donors, corporations, grants are primarily the events planning, memberships. That's usually how they fund their business. So if they haven't started that, I mean, that could be a great source to start getting some funding. And once they get into a more solidified stage, I would recommend probably getting into that. But for now, I mean, there's other opportunities out there that they can get access to.
And can I add, sorry, one more. So a lot of the banks, we have our Community Reinvestment Act or a CRA department. They can ask grants from a lot of the banks. We have a budget for that we need to give back to the community, to FYI.
Well, this has been fantastic. Unfortunately, we are at time, and I do want to be respectful of everyone's time. I want to thank Ila Gomez of Bank of California, Amy Nelson of Rethink Capital Partners, and Oscar Franco of Founders First Capital Partners for joining us today. We will be sending out the recording later today, if not in the morning. That email will also contain the contact information for each of today's speakers. We really appreciate you all joining us. Feel free to connect with them individually for any questions that you did not get answered today. And we'll see you on the next webinar. Thank you, everyone. Thank you, Ila. Thank you, Amy. Thank you, Oscar.
Happy holidays. Thank you.
Happy holidays, everyone. Take care.
Thank you.